All right, guys. Hey, something went wrong with my previous video upload, so we got to do it again. I apologize for the dress. I'm North Carolina, so we're gonna do this real quick. Let's go to our mind tap. See if we can get that. We got the course launched. The course. You want to go to your outline view. Let's go to chapter 15. I believe we left off on 5.1, so let's go to 5.2. Oops. There we go. Let's do the work together. So, I'm going to beat the clock and just copy this into another screen just in case we have some questions. We'll be able to get started that way and be able to look at some things. All right. So 15-2. Let's see what we're looking at. We got some more adjustment data. No big deal. From a physical account, we're looking at our merchandise inventory. They give us the adjusted trial balance. They show our previous adjusted entries. And remember, I went wrong because I only did supplies, expense office. I needed to do supply store, what have you. It looks like they gave us enough room for 2 more entries. So from a physical account, we got merchandise inventory. The key about merchandise inventory is that we adjust that in income summary, right? That's that temporary account that we only use for things like merchandise inventory. We'll also use it for our taxes to figure some things out. They also mentioned a single notes receivable is outstanding. So we have a notes receivable. That's some monies people owe us. So we're going to have to take into account the interest we're going to receive on that note receivable. So let's just get started. All right, first things first, merchandise inventory, December 31st. Let's put our date in. Let's figure out, well, you got to ask yourself the 4 questions. What did we start with? From a physical account, merchandise inventory, December 31st balance is determined to be $96,000. So right now we have $96,000. If we go look at our adjusted trial balance, we started off with $94,000. If we have $96,000, we started off with $94,000. We added approximately $2,000. I'm going to grab my handy dandy calculator. Let's go down here. Let's search for my calculator. Applications. There it is. Let's get rid of this. So we started with $94,845.31. And now I'm putting minus, but it's really not a minus because, I should have started with the bigger number. We now have $96,471.25, 0.25. So we've added $1,625.94. If you look at your merchandise inventory, it's an asset, right? And when assets increase, we debit it. So we're going to go down to our merchandise inventory. And we're going to debit it. We're going to debit it for $1,625. $1,625. You know what? Let me close this a little bit so I can see it better. Good. 25.94 cents. And we're just going to put that in income summary. Income summary. We know we have to have a credit for every debit. So without even thinking, I know this goes into 1625.94. Outstanding. So now we go to our last adjustment entry. We have a single note receivable is outstanding on December 31st. The 90-day 8% note was signed on November 22nd. November 22nd to December 31st is only how many days? 22 days, right? So we'll keep it real simple. We got 22 days, 8% interest on our note. Let's find out what our note is. Interest receivable. So, and this is why I open up 2 screens, just to remind myself, keep things easy. I'm going to close that. We're going to go to our adjusting entry to see how they do an interest receivable. I don't remember. It's been a while. So there's our income summary. Notice when it goes down, Merchandise inventory was credited, but ours went up. Beginning, ending. Let's go to the next page. Over. Accounting for accrued revenue, and that's what this is, right? So good. Here's our notes receivable. So we have interest receivable, interest income. What's going up, what's going down. And that's what we're looking for. So let's figure out our accrued interest income. So we're going to go back. Interest receivable is blank. Where's our interest income? I'm sorry, we're looking for our notes receivable. Where's our notes receivable? There it is, notes receivable. So we have an $8,000 note. 8, 1, 2, 3 times. What's our percentage for the year? If we go back to our adjustment data, times 0.08, that would be for the year, but we didn't get it for the whole year. We only had it for 22 of the 90 days. So we're going to divide it by 90, multiply that times 22. We have $156.44. 156.44 cents, 156. And so now we just need to debit in our credits. So if you go back up to the top, if you don't remember off the top of your head, if you look at what needs to be debited, well, we just got some interest receivable. That was the money that's coming in. So it's going to be 156.44. And the opposite is interest income. So let's go back down. We got interest receivable. And interest income. Oops. Both on the 31st. Income, and that looks real good to me. So we have our two entries. Let's see if I can find my finish button. Good. Oops. Let's go save and continue. I'm feeling pretty good. Let's see the results. We go down. Oh, we can't see the results because we have to look at this one. Let's go back. Looks pretty good. Wait, oh, I got a grade. That's my problem. Not save and continue. Let's go save and continue. Where's my grade? Save and continue. I'm done grade assignments now. Yes. 2.83. Let's see if we got those right. Oh, they said my interest receivable was off. I have to check my dates. Get right back to you guys on that. All right, bye. All right, so I went back, checked my numbers to see where this all went wrong. And of course, it was on our calculations for our interest receivable. I don't know why you guys didn't stop me. Somebody's got to send me a text or something to say, hey, Mr. Ma, you're doing this wrong. It's a real simple calculation. I don't know if I didn't know December and November, how those 2 months work, but I obviously had them backwards. Okay, so here's the deal. Our note is for $8,000. We have an 8% interest rate, 0.08. That's the amount of interest we could receive if we did it for an entire year. An entire year, how much is that per day? So we have to divide that by 360. I think I made the mistake and divided it by 90. You don't want to divide it by 90. You want to divide it by 360. That's how many days are in a year. So each day we can get $1.78 per day of interest on this note receivable. But wait a minute, we didn't have the entire year. We had from November 22nd to December 31st. November 22nd to the end of November, that's 8 days. December to December 31st, that's 31 days. So a total of 39 days. If you multiply that times 39 days, you get $69.33. What does it say down here? $69.33. Again, my mistake, but that's what we do with the growth mindset. We make our mistakes and we move on. So now you'll never forget how to do interest receivable. Take the note. Take the percentage of interest you get. Divide it by 360 days. That's how many days are in a year. Multiply by the number of days that the note was outstanding. It was 8 days in November, 31 days in December, 39 days total. Multiply that times 39, 69.33. All right. That was 15-2. Let's move on to 15-3. We got to get through this stuff. Let's go.